What if building wealth didn't require picking winning stocks, predicting the next market crash, or paying someone thousands of dollars for financial advice? For decades, thousands of ordinary investors have been quietly following a much simpler strategy: save consistently, keep costs low, own the market, and stay the course. No hot stocks, no complicated formulas, just a remarkably simple system for building wealth. And today, we're breaking down exactly how it works. There's a small, unglamorous corner of the internet where for more than 2 decades, ordinary people with no financial credentials whatsoever have been quietly helping each other make some of the biggest financial decisions of their lives entirely for free, with no advertisements, no sales pitches, and no hidden agenda beyond simply wanting to see each other succeed. It started, almost by accident, on an online discussion forum in the late 1990s, when a small group of individual investors, inspired by the writings of a single Vanguard founder, began gathering to discuss his ideas, share their own experiences, and help newcomers navigate the confusing, often intimidating world of personal investing. They called themselves, half-jokingly at first, the diehards, a nod to their stubborn devotion to a specific set of principles most of the mainstream financial industry seemed determined to talk them out of. The forum itself began on a financial website's message board, a relatively obscure corner of the internet at the time, where a handful of early participants discovered they shared not just an admiration for a particular investing philosophy, but a genuine willingness to spend their own free time patiently helping total strangers work through their own specific financial questions, one detailed, carefully considered reply at a time. What began as a modest handful of regular posters gradually attracted more and more participants, drawn in by word of mouth, by search engines turning up old forum threads answering exactly the question a new visitor happened to be searching for, and eventually by the community's own growing reputation as a genuinely reliable, genuinely trustworthy source of practical financial guidance. Uncorrupted by the sales incentives that shaped so much of the rest of the financial advice landscape, the authors describe the specific, somewhat improbable circumstances that eventually led the community to migrate from its original host site to an independent, dedicated forum of its own. A transition driven partly by the community's own continued growth outstripping what the original borrowed platform could comfortably support, and partly by a shared desire among the community's most active members to build something more permanent and more fully under their own collective stewardship. Several longtime members volunteered their own time and technical skills to build and maintain this new independent platform. A genuinely grassroots effort funded and operated almost entirely by volunteer contributions rather than any commercial sponsorship, reinforcing the community's own deeply held identity as a genuinely independent, member-driven resource, free from the kind of commercial pressures that so often compromise similar financial communities elsewhere online. They describe the community's own careful, deliberate approach to maintaining that independence over the years that followed, describing internal discussions and explicit policies designed specifically to prevent the forum from ever becoming a vehicle for promoting any specific commercial product or service. Even as the community's own growing size and influence would have made such commercial partnerships genuinely lucrative had the community's leadership ever chosen to pursue them. The authors treat this sustained commitment to remaining free of commercial influence as one of the community's single most important, most carefully guarded values, the specific foundation that allows members to trust the guidance they receive as genuinely, disinterestedly aimed at their own best interests rather than quietly shaped by some hidden commercial agenda. They contrast this specific independence directly against the ordinary structure of much of the rest of the financial advice industry, where advisors, brokers, and various financial products routinely generate commissions or fees for whoever happens to be recommending them, creating exactly the kind of structural conflict of interest the community's own founding members had originally organized, specifically to avoid encountering themselves. The authors describe this contrast as a genuinely meaningful practical advantage available to any reader willing to invest the time in learning the community's own well-tested principles directly, rather than continuing to rely exclusively on advice from parties whose own financial interests might not always fully align with the reader's own genuine best interests. They're careful to note that this specific independence doesn't mean the community rejects professional financial advice, categorically acknowledging that some readers, particularly those with genuinely complex financial situations, may still benefit from working with a qualified, properly credentialed advisor. But they encourage even those readers to approach that relationship armed with genuine independent understanding of the community's own core principles, better equipped to evaluate whether a given advisor's specific recommendations genuinely align with sound, evidence-based practice, rather than entering that relationship without any independent basis for evaluating the guidance received. That small community eventually grew into something considerably larger, an entire self-sustaining online movement, complete with its own extensively maintained reference wiki, regular in-person meetups held across the country, and eventually its own published book, written collaboratively by several of the community's most active, most trusted members, distilling decades of collective wisdom into a single practical guide. The community's own reference wiki deserves particular mention, since it represents a genuinely unusual, collectively built resource within the broader financial world, an extensive, continuously updated encyclopedia of practical investing knowledge. Written and maintained entirely by volunteer community members with no financial stake whatsoever in whichever specific advice happened to be included, updated and refined collaboratively over years as tax laws changed, as new investment products emerged, and as the community's own collective understanding continued deepening through countless individual conversations. The authors describe this wiki as in many ways an even more comprehensive resource than the book itself, a living, continuously evolving reference that individual forum members regularly consult and contribute to correcting outdated information, adding newly relevant detail, and generally treating the resource with the same careful, collaborative stewardship. An open reference project of this kind genuinely requires to remain reliable and useful over time. They also describe the community's own tradition of regular in-person meetups, gatherings held in cities across the country where members who had spent years exchanging advice purely online finally had the opportunity to meet each other face-to-face, share meals together, and continue the same kind of patient, mutually supportive conversation that had originally drawn them to the online forum in the first place. The authors describe these gatherings with genuine warmth, noting how many longtime members describe forming genuine lasting friendships through the community, relationships that began purely around a shared interest in sound, disciplined investing principles, but that gradually grew into something considerably deeper and more personally meaningful over years of continued patient mutual support. One of the community's own most frequently retold stories, referenced throughout the book as a kind of emotional touchstone for what the entire community ultimately exists to accomplish, involves a grieving widow who arrived on the forum shortly after her husband's death, having suddenly inherited full responsibility for a substantial retirement portfolio she had never personally managed or even fully understood her late husband, having quietly handled all of their household's financial decisions throughout their entire marriage. Overwhelmed, grieving, and genuinely frightened by the sudden weight of decisions she felt entirely unprepared to make, she posted her situation openly on the forum, describing her late husband's specific holdings and asking with evident vulnerability for whatever guidance the community might be willing to offer. What followed, the authors describe, was among the community's own finest moments. Dozens of experienced members responding with genuine patience and compassion, walking her carefully through her specific situation, explaining unfamiliar terms without condescension, helping her understand and eventually simplify an unnecessarily complicated collection of holdings into something considerably more manageable, and checking back in with her over following weeks and months, simply to see how she was doing both financially and personally. The authors describe this specific thread as having become something of a founding legend within the community's own collective memory, frequently cited in later years whenever newer members wondered aloud what the community was actually for. Beyond simply debating the finer technical points of index fund selection, they connect this story directly back to something they consider genuinely central to the entire community's identity, that the underlying investment principles themselves, however soundly built on decades of solid financial evidence, ultimately exist in service of something considerably more human. Genuine peace of mind, genuine security for the people an investor cares about, and genuine relief from the kind of paralyzing financial anxiety that grief, uncertainty, or simple unfamiliarity can otherwise create. The authors argue that this specific story captures something a simple list of 10 investment principles alone could never fully convey: the genuine human warmth underlying an entire community built ultimately around helping ordinary people take care of each other. They describe hearing in later years that this same widow eventually became an active, regular contributor to the community herself, having gained enough confidence and understanding through her own initial experience to begin offering the same kind of patient guidance to other newly widowed or otherwise suddenly overwhelmed members who arrived on the forum seeking similar help. The authors treat this specific detail, a person who once arrived frightened and overwhelmed eventually becoming a source of calm, patient support for someone else facing the same fear, as perhaps the truest embodiment of what the entire community had actually built over its many years of existence: a genuine, self-sustaining cycle of ordinary people helping each other, one honest, patient conversation at a time. That book is The Bogleheads Guide to Investing, and unlike a great many personal finance books written by a single celebrity author or a single Wall Street professional, this one carries something genuinely different at its core: the accumulated hard-won experience of thousands of ordinary people comparing notes with each other in real time, watching what actually worked and what actually didn't over years and years of real money and real mistakes. The book's own introduction makes this specific distinction explicit, with the authors openly acknowledging that they weren't presenting themselves as elite financial professionals dispensing expert wisdom from some privileged vantage point, but rather as ordinary self-taught investors, no different in background or credentials from the very readers they were writing for, who happened to have spent years carefully studying, testing, and refining a specific set of principles alongside thousands of similarly ordinary community members. This particular framing, the authors note, was entirely deliberate, meant to reassure readers from the very first pages that genuinely sound, disciplined investing was accessible to anyone willing to learn, regardless of their own starting level of financial sophistication or their own current account balance. Stick with this one, because the specific practical wisdom baked into this book didn't come from a single genius working alone in an office. It came from an entire community stress testing a shared set of principles against real life, together for decades. And it might be one of the most genuinely useful, genuinely tested guides to ordinary personal investing you'll ever come across. And if you enjoy discovering the most powerful ideas from the world's best books on money, investing, and wealth, subscribe to Money Files audiobooks. We turn these books into deep, practical stories designed to help you understand money without all the unnecessary noise. Now let's get into the principles that made this community's approach so powerful. The community itself takes its name directly from John Bogle, the founder of Vanguard and the pioneer of low-cost index investing, whose own writing and public speeches first drew this scattered group of like-minded investors together in the first place. Bogle himself, by most accounts, was genuinely touched by the community that grew up around his ideas, occasionally participating directly in the forum's discussions himself, answering questions personally from ordinary members, and eventually attending several of the community's own in-person gatherings before his death. A level of direct engagement between a famous financial figure and an entirely grassroots community of ordinary followers that remains genuinely unusual within the broader financial world. The authors describe several specific occasions when Bogle personally attended the community's own conferences. Standing before rooms full of ordinary investors who had built their own entire financial lives around principles he'd first articulated decades earlier, taking questions directly, sharing personal stories, and expressing genuine, evident delight at seeing his own life's work translated so directly and so effectively into the real tangible financial security of thousands of ordinary people he'd never have otherwise met individually. Several longtime forum members describe these specific encounters, meeting Bogle personally at one of these gatherings as among the most genuinely meaningful moments of their entire involvement with the community, a direct personal connection to the original source of the philosophy that had in many cases fundamentally transformed their own financial futures. The authors describe Bogle's own reaction to having an entire community adopt his name so directly and so affectionately as a mixture of genuine humility and evident pride, recounting his own repeated insistence in public remarks to the community that the credit truly belonged to the community members themselves for having the discipline to actually apply his ideas consistently, rather than to him personally for simply articulating them in the first place. This specific humility, several longtime members note, only deepened the community's own affection and respect for him, reinforcing rather than undermining the sense that the entire movement genuinely belonged to its ordinary members collectively, rather than functioning as any kind of top-down celebrity-led enterprise. The book itself was written collaboratively by three of the community's most respected longtime members, each bringing a slightly different personal background and personal investing story to the project, but united by the exact same underlying philosophy, one built directly on the foundation. Bogle himself had spent his own career championing low costs, broad diversification, patient discipline, and a healthy, well-earned skepticism toward anyone promising an easy shortcut to genuine, lasting wealth. One of the three authors had spent his own earlier career in an entirely unrelated field, only discovering the specific investing principles that would eventually define much of his later life, relatively late, after a personal encounter with poor, expensive financial advice convinced him to educate himself thoroughly rather than continue trusting an industry whose incentives he came to realize weren't always genuinely aligned with his own best interests. He went on to become one of the forum's most prolific, most trusted contributors, known throughout the community for his patient, detailed, endlessly generous responses to newcomers' questions, often walking a single anxious new member through their entire personal financial situation across dozens of individual forum posts entirely as a volunteer, purely out of genuine care for helping a fellow investor avoid the same costly mistakes he himself had once nearly made. A second author brought a background in business and management consulting to the project, contributing a particular clarity and structure to how the book's underlying principles were eventually organized and presented, helping translate what had originally existed as thousands of scattered informal forum conversations into the clear, accessible, systematically organized guide the finished book eventually became. This same author had, prior to becoming deeply involved with the community, spent years working through the same kind of confusing, sometimes contradictory financial advice ordinary readers regularly encounter, describing his own path toward the community's core principles as a gradual, hard-won process of comparing conflicting recommendations, testing claims against actual historical data, and slowly, carefully building genuine confidence in the specific, evidence-based approach the community had already converged on collectively. He describes this personal journey as directly shaping his own particular contribution to the finished book, a deliberate emphasis on walking readers through not just what the community recommended, but why. Showing the underlying evidence and reasoning clearly enough that a genuinely skeptical reader could independently verify the logic for themselves rather than simply being asked to trust the author's own authority. The third author brought yet another distinct perspective, drawing on decades of his own personal investing experience and considerable prior experience actually writing and publishing his own personal finance content, helping shape the book's overall voice and ensure that its guidance remained genuinely accessible to readers with little or no prior financial background, rather than drifting into the kind of dense, jargon-heavy language that so often makes personal finance writing considerably less useful to the very ordinary people who need it most. This same author brought a particular sensitivity to the book's overall tone, having spent considerable time prior to joining this specific project thinking carefully about how to communicate genuinely sound financial guidance to readers who might feel intimidated, embarrassed, or simply overwhelmed by the subject matter emotions the author himself recalled experiencing at various points earlier in his own financial life. He describes deliberately pushing back during the collaborative editing process against any passage that felt condescending or unnecessarily technical, insisting throughout on language a genuinely uninitiated reader could follow comfortably without ever feeling talked down to or made to feel foolish for not already understanding a given concept. The authors describe the collaborative writing process itself as, in many ways, a direct extension of the same community spirit that had originally brought them together as forum participants, each author reviewing and refining the other's contributions, extensively drawing on feedback from the broader community throughout the drafting process, and treating the finished book less as any single individual's personal statement and more as a genuine collective distillation of thousands of community members' accumulated wisdom, carefully organized and clearly presented for a considerably wider audience than the original forum's own membership had ever directly reached. They describe soliciting direct feedback from the broader community at multiple stages throughout the writing process itself, sharing early drafts of individual chapters with active forum members and incorporating their detailed responses, corrections, and suggested additions before the manuscript was ever finalized. Several specific stories and examples that eventually appeared in the finished book, the authors note, were contributed directly by ordinary community members responding to these early drafts, sharing their own personal experiences, precisely because they recognized how directly those experiences illustrated whichever specific principle a given chapter happened to be discussing. This unusually collaborative writing process, the authors argue, is precisely why the finished book reads less like a single expert's confident pronouncements and more like an entire community speaking with one clear, consistent, thoroughly tested voice. The book organizes its guidance around a specific list of principles the community itself has refined and repeated so often over the years that most active forum members can recite them almost from memory, principles distilled from thousands of individual conversations, thousands of individual mistakes shared openly and honestly, and thousands of individual success stories built patiently over years of disciplined, unglamorous saving. The authors describe the specific, somewhat unusual process by which this particular list of 10 principles actually came together, noting it wasn't handed down from any single individual's own personal philosophy, but rather emerged gradually over years as the community's own recurring discussions kept circling back to the same handful of core ideas again and again, regardless of which specific question a newer member happened to be asking that particular week. Eventually, several longtime members began explicitly cataloging and naming these recurring themes, and the resulting list, refined further through additional community feedback and discussion, became the specific organizing structure the finished book was ultimately built around. The first principle is disarmingly simple, and yet it sits underneath every single piece of guidance that follows throughout the rest of the book. Live below your means and save regularly. No investment strategy, however sound, can help someone who never actually has any money left over to invest in the first place. The book spends real time on this specific point, treating genuine, disciplined saving not as some background assumption to be glossed over quickly on the way to more exciting investment discussions, but as the single most important habit an ordinary person can build, the actual foundation everything else in the book depends on entirely. The authors are careful to distinguish this specific principle from mere frugality for its own sake, emphasizing that the goal isn't simply spending as little as possible on every single category of expense, but rather making deliberate, conscious choices about where genuine spending actually aligns with an individual's own genuine values and priorities, while consciously trimming spending in areas that don't genuinely contribute to that same sense of meaning and satisfaction. They share several community discussions illustrating this specific distinction, describing members who happily spent generously on specific categories they genuinely valued: travel, hobbies, time with family, while deliberately minimizing spending in other categories that mattered considerably less to their own personal sense of a genuinely well-lived life, arriving at a genuinely sustainable, intentional balance, rather than either reckless overspending or joyless blanket austerity. The authors share numerous stories from their own community's collective experience, illustrating this exact point, describing forum members who, despite earning genuinely modest incomes throughout their entire working lives, managed to accumulate substantial, genuinely life-changing nest eggs, purely through the consistent, disciplined habit of living meaningfully below their actual means and directing that consistent surplus toward regular automatic investing year after year, decade after decade. They contrast this against equally common stories of forum members who earned considerably higher incomes throughout their careers, but who had never actually built this same underlying habit, and who found themselves, despite that higher income, with considerably less to show for it by the time retirement actually arrived. One specific story the authors return to repeatedly throughout the book involves a school teacher who spent an entire career earning a modest, unremarkable salary, never once earning anywhere close to what many of the forum's other, more highly compensated members brought home each year. Yet, by consistently living well below that modest income, automatically directing a meaningful percentage of every paycheck toward simple, low-cost index funds, and never once wavering from that discipline across 4 full decades of steady contribution, this same teacher retired with a genuinely substantial nest egg, one that many considerably higher-earning forum members, lacking that same underlying discipline, never actually managed to match. The authors treat this specific story as a recurring, almost sacred touchstone throughout the community's collective folklore, proof that the size of an income matters considerably less than the discipline applied to whatever income an individual actually happens to earn. They contrast this specific success story against an equally instructive cautionary tale describing a forum member who arrived seeking help after years of earning a genuinely substantial income, working in a demanding, well-compensated professional career, only to discover, upon finally sitting down and calculating their actual accumulated savings, that decades of steady lifestyle inflation, gradually upgrading cars, homes, and vacations in step with each successive raise, had left surprisingly little actually set aside for the future. Despite that consistently strong income, the authors use this specific, sobering contrast to drive home one of the community's most deeply held convictions, that genuine financial security has always depended far more on the discipline of consistent saving than on the raw size of any individual's paycheck. The second principle addresses a genuine, unavoidable tension every investor eventually has to confront directly, understanding the fundamental trade-off between risk and reward. The book walks through this relationship in accessible, practical terms, explaining that investments offering higher potential long-term returns, most notably stocks, also carry genuinely higher short-term volatility and genuine risk of temporary loss, while investments offering greater short-term stability, most notably bonds and cash, typically offer correspondingly lower long-term growth potential in exchange for that added stability. The authors illustrate this fundamental relationship with a specific, memorable comparison drawn from decades of the community's own accumulated historical data. Contrasting the dramatically different paths a hypothetical all-stock portfolio and a hypothetical all-bond portfolio would have taken across several specific real historical periods, including both periods of strong economic growth and periods of genuine economic hardship. They show how the all-stock portfolio, while producing considerably higher average long-term returns across the full historical period examined, also experienced meaningfully larger, more frightening temporary declines along the way, while the all-bond portfolio, while producing a considerably smoother, more predictable ride, also produced considerably lower cumulative growth by the time the full period had elapsed. This specific contrast, the authors argue, isn't meant to suggest one particular allocation is simply objectively better than the other in some universal sense. It's meant to help readers genuinely understand in concrete, historically grounded terms exactly what trade-off they're actually making whenever they choose a specific mix between these two broad asset categories, so that the choice they eventually settle on reflects a genuine, informed understanding of the trade-off involved rather than either naive optimism about stocks' higher average returns, without properly weighing the genuine volatility involved, or excessive caution that fails to properly account for the very real quiet cost of insufficient long-term growth. This leads directly into the third principle, closely related to the second. Never take on too much risk, and never take on too little either. The authors devote considerable attention to both sides of this specific balance, since each carries its own genuine, well-documented danger. An investor taking on too much risk, holding an overly aggressive stock-heavy portfolio without adequate consideration for their own genuine tolerance for volatility risks, panicking and selling at exactly the wrong moment during an inevitable market downturn, locking in real permanent losses that a more balanced approach would have avoided entirely. But an investor taking on too little risk, holding an overly conservative cash-heavy portfolio out of excessive caution risks a different, quieter danger. Watching inflation steadily erode their own purchasing power over decades, while missing out on the genuine, substantial long-term growth a more balanced approach would have captured. They share two contrasting stories from the community's own collective experience, illustrating each side of this balance in vivid, concrete terms. The first describes a forum member who, excited by strong recent market performance and confident in their own ability to handle volatility, had built an aggressively concentrated portfolio holding almost entirely individual growth stocks, with essentially no bond allocation or broader diversification at all. When a severe market downturn eventually arrived, that same investor discovered their actual tolerance for watching a large portion of their savings evaporate within a matter of weeks was considerably lower than they'd confidently assumed beforehand, and they ultimately sold near the very bottom, converting a genuinely painful but recoverable paper loss into a permanent realized one. The second story describes an entirely different forum member. This one so thoroughly frightened by the possibility of ever experiencing that same kind of painful decline that they had kept the overwhelming majority of their life savings sitting in ordinary cash for decades, never investing meaningfully in stocks at all. By the time this same investor finally sought guidance from the community well into their own retirement years, they discovered with genuine dismay just how significantly decades of persistent inflation had quietly eroded the real purchasing power of that carefully guarded cash, leaving them with considerably less genuine financial security than a more balanced, appropriately risk-tolerant approach would have provided across that same multi-decade period. The authors use these two contrasting stories throughout the book as a recurring cautionary reminder that both extremes, excessive risk-taking and excessive risk avoidance, carry genuine, well-documented costs, and that finding an appropriately balanced middle ground suited to an individual's own genuine circumstances and temperament matters considerably more than simply avoiding one extreme by rushing headlong into the other. The fourth principle, diversify, extends directly from these first three, encouraging investors to spread their holdings broadly across many different companies, industries, and asset classes, rather than concentrating too heavily in any single investment, however promising that single investment might currently appear. The authors walk through the specific mathematical and psychological benefits of this kind of broad diversification in accessible terms, echoing much of the same underlying reasoning found throughout the broader index investing tradition the community itself grew directly out of. They extend this diversification discussion beyond simple stock market diversification alone, addressing a specific, closely related danger the community has observed repeatedly among newer members holding an excessive concentration of employer stock within a retirement account, often accumulated automatically through company stock purchase plans or matching contributions made directly in company shares rather than cash. The authors walk through why this specific concentration represents a particularly dangerous form of undiversified risk, since an employee's own paycheck and their retirement savings both become tied to the exact same underlying company's fortunes simultaneously, meaning a serious downturn at that specific employer risks damaging both an investor's current income and their accumulated retirement savings at precisely the same moment, compounding one financial setback with another rather than the broader portfolio's diversification cushioning the blow. They share a specific sobering account from the community's own history describing a forum member who had accumulated a dangerously large concentration of employer stock over many years of consistent company matching contributions, never having thought carefully about actively diversifying that specific holding away. When that particular company later experienced serious financial difficulties, this same investor watched a substantial portion of their retirement savings decline dramatically in value at almost exactly the same time their own job security at that company also became genuinely uncertain. Precisely the double jeopardy the community's diversification principle exists specifically to help investors avoid. The authors use this account to underscore a specific practical piece of guidance repeated often throughout the community's own discussions that any single employer stock holding, however much an investor might genuinely believe in their own company's future prospects, generally deserves to be actively, periodically diversified away rather than allowed to accumulate indefinitely into an outsized, dangerously concentrated position. They offer a specific, practical rule of thumb the community frequently cites when discussing this exact concentration risk, suggesting that no single employer stock holding should generally be allowed to grow beyond a modest single-digit percentage of an investor's total overall portfolio, and that any employer stock exceeding that rough threshold deserves serious deliberate consideration for gradual systematic diversification into the broader, more balanced holdings recommended throughout the rest of the book. They acknowledge this specific guidance can feel genuinely difficult to follow in practice, particularly for investors who feel a strong, understandable sense of loyalty and confidence in their own employer, but they consistently return to the same underlying reasoning. That genuine financial security depends on protecting against exactly the kind of correlated compounding risk that concentrated employer stock holdings quietly create, regardless of how justified an individual's own optimism about their specific employer's future might otherwise feel. They connect this diversification principle directly to a practical, frequently discussed community guideline for determining an individual's own appropriate mix between stocks and bonds, sometimes summarized using a simple rule of thumb: subtracting an investor's own current age from a fixed reference number to arrive at a rough starting percentage for stock allocation with the remainder allocated toward bonds. A younger investor decades away from needing to draw on their savings would, under this rough guideline, hold a considerably higher percentage in stocks, while an investor approaching retirement would gradually shift toward a higher percentage in bonds, reflecting that investor's shrinking remaining time horizon and correspondingly reduced capacity to simply wait out a severe temporary market downturn. The authors are careful to present this specific rule of thumb as a genuinely useful starting point for discussion, rather than a rigid, universally correct formula applicable identically to every single investor regardless of their own personal circumstance. They walk through several specific factors worth adjusting for beyond simple age alone, an individual's own personal tolerance for watching their portfolio's value decline temporarily, the presence or absence of other sources of guaranteed retirement income like a pension, and an individual's own specific timeline for actually needing to draw on their invested savings. A younger investor with a genuinely low tolerance for watching their account balance swing dramatically, they note, might reasonably choose a somewhat more conservative allocation than the simple age-based rule alone would suggest. Since the single most important factor in any successful long-term investment strategy remains an investor's own genuine ability to actually stick with that strategy through an inevitable uncomfortable downturn rather than abandoning it in a panic at precisely the wrong moment. The fifth principle addresses a temptation nearly every investor eventually faces at some point, and one the community's own collective experience has proven, again and again, to be genuinely costly. Never try to time the market. The book walks through decades of accumulated evidence, much of it drawn directly from the community's own shared experiences, showing that attempting to predict short-term market movements, buying right before an anticipated rise, and selling right before an anticipated fall reliably fails far more often than it succeeds, even among genuinely intelligent, well-informed investors who feel confident in their own predictive abilities. The authors share a specific recurring pattern they've observed repeatedly across the community's own collective history: investors who moved substantial portions of their portfolio into cash during a period of genuine market anxiety, fully intending to wait for a clearer, safer moment before getting back in, only to watch the market recover considerably faster and considerably more strongly than they'd anticipated, leaving them stuck on the sidelines, having missed a substantial portion of the subsequent recovery. Precisely the outcome the entire strategy had been intended to avoid in the first place. They describe one particularly detailed account shared on the forum by a member who had, during a genuinely frightening market downturn, moved nearly their entire retirement account into cash, convinced that further, deeper declines were surely still ahead. That same member later posted a candid, retrospective account of the decision, describing how the market's own eventual recovery unfolded considerably faster than any reasonable person could have confidently predicted in advance, and how the specific agonizing psychological difficulty of ever deciding when exactly to get back in, once the initial fear had passed, had cost that investor considerably more in missed gains than the original decision to sell had ever protected against in losses avoided. The authors present this account, and dozens of similar ones scattered throughout the community's own archive discussions, as living proof that market timing's core problem isn't simply guessing wrong about the market's direction. It's the fact that even guessing right about one specific moment, selling before a decline, still requires guessing right a second time, correctly identifying when to buy back in, a genuinely difficult double bet that even skilled, experienced investors reliably fail to win consistently over time. They also address the specific related temptation to sit on the sidelines entirely, waiting indefinitely for some clearer, more comfortable moment before ever getting invested in the first place, a pattern the community has observed just as often among newer, more anxious members hesitant to begin investing at all. The authors offer a specific practical reassurance for exactly this kind of hesitation, pointing out that the specific moment always feels uncertain regardless of what point in market history an investor happens to be standing at, and that waiting indefinitely for that uncertainty to fully resolve itself before beginning to invest tends to cost considerably more in lost years of compounding than simply beginning with a sensible, diversified approach as soon as reasonably possible. However imperfect the current market conditions might currently feel, they share a specific related piece of practical guidance the community frequently offers to exactly this kind of hesitant, anxious newcomer, suggesting a gradual, phased approach to entering the market for readers who find the idea of investing a large lump sum all at once genuinely too anxiety-inducing to comfortably follow through with, even after intellectually understanding the mathematical arguments favoring immediate full investment. Spreading a large initial investment across several months rather than committing it all in a single transaction, the authors explain, doesn't reliably improve an investor's expected long-term return, and the community's own research generally favors investing available funds as promptly as reasonably possible. But they acknowledge that for some genuinely anxious newcomers, this more gradual approach offers a real, meaningful psychological benefit, easing them into full market participation without the specific acute anxiety of watching a single, large, all-at-once investment immediately fluctuate in value, a worthwhile trade-off in their assessment. If it means the difference between an anxious newcomer actually following through with investing at all versus remaining paralyzed indefinitely on the sideline. The sixth principle: use index funds when possible, brings the community's underlying philosophical debt to Bogle himself into its most explicit, direct form. The authors walk through much of the same core argument found throughout Bogle's own writing, that broad, low-cost index funds, simply capturing an entire market's overall return, rather than attempting to select individual winning stocks, have reliably outperformed the majority of actively managed alternatives over any sufficiently long period once the full weight of fees, trading costs, and taxes has been properly accounted for. The authors describe how deeply this specific principle shaped the community's own founding identity, noting that the forum's original participants gathered specifically because they'd each independently arrived at this same conclusion, largely through their own careful reading of Bogle's own writing and speeches, and found genuine relief in discovering an entire community of like-minded people who shared their own growing skepticism toward the broader financial industry's more elaborate, more expensive promises. They describe countless individual forum threads over the years where a newer member, still holding a collection of expensive, actively managed funds recommended by a traditional financial advisor, posted their own portfolio for feedback and received patient, detailed, thoroughly evidence-based responses walking through exactly why a simpler, lower-cost alternative would likely serve that same member considerably better over their own remaining investing lifetime. This connects directly to the seventh principle: keep costs low, which the authors treat with almost the same intensity Bogle himself brought to the subject throughout his own career. The book walks through concrete examples of exactly how dramatically seemingly small differences in annual fees compound into genuinely enormous differences in an investor's final accumulated wealth over a multi-decade investing career. Precisely the same underlying arithmetic Bogle spent his own career championing, now filtered through the collective real-world experience of an entire community of ordinary investors who had actually lived through the consequences of that arithmetic themselves. They share a specific, memorable community exercise that became something of a recurring tradition on the forum over the years, members calculating and posting exactly how much their own specific fee savings, compared to a hypothetical more expensive alternative portfolio, had actually amounted to in real dollar terms over their own personal investing history, a running collectively documented testament to the practical, tangible value of the community's shared cost consciousness, accumulated one individual member's personal calculation at a time. The authors walk through a specific, illustrative version of this exact calculation, worked through step by step for readers to follow along with directly. An investor contributing a consistent amount every year over a full multi-decade career, earning the market's own long-term average return, but choosing a fund charging a fraction of a % in annual fees rather than a considerably more expensive alternative, ends up by the calculation's conclusion with a final balance meaningfully larger, often by well over $100,000 over a genuinely long enough career, purely as a consequence of that seemingly modest annual fee difference compounding quietly across decades. The authors present this specific, concrete figure deliberately, knowing from years of community experience that an abstract percentage rarely produces the same motivating clarity as watching that same difference translated into a genuinely life-changing dollar amount. The eighth principle: minimize taxes, extends this same cost consciousness into the specific, often overlooked realm of tax efficiency, encouraging investors to make full deliberate use of tax-advantaged retirement accounts and to think carefully about which specific types of investments belong in which specific types of accounts in order to minimize the unnecessary tax drag that can otherwise quietly erode an investor's genuine long-term returns. The authors walk through the specific mechanics of the most common tax-advantaged account types available to ordinary investors in accessible practical detail, starting with employer-sponsored retirement accounts, which typically allow contributions to grow either tax-deferred, with taxes paid only once the money is eventually withdrawn in retirement, or in certain variations, tax-free upon withdrawal in exchange for contributing already taxed dollars up front. They walk through individual retirement accounts as well, available to ordinary investors independent of any specific employer, offering broadly similar tax advantages, along with considerably more flexibility in choosing exactly which specific investments to hold within the account. They introduce a specific practical concept the community has come to call asset location, distinct from the more familiar concept of asset allocation, addressing the strategic question of which specific investments belong in which specific type of account, given the different tax treatment each account type offers. Investments generating a great deal of taxable income each year, they explain, generally belong preferentially within tax-advantaged accounts, sheltering that income from immediate taxation, while investments generating relatively little taxable income along the way, relying instead on long-term price appreciation, can reasonably be held within an ordinary fully taxable account without sacrificing much in the way of genuine tax efficiency. They walk through an additional, closely related tax-advantaged account, worth understanding, one specifically designed for healthcare expenses, offering a particularly favorable combination of tax benefits that the community's own collective research has identified as genuinely underutilized by a great many ordinary investors who qualify for it. Contributions to this specific account type typically reduce an investor's current taxable income. The account's investment growth accumulates entirely tax-free, and withdrawals used for genuine qualified medical expenses similarly avoid taxation altogether. A specific combination of tax advantages the authors describe as genuinely unmatched by any other commonly available account type. They encourage readers who have access to this specific account option and who can genuinely afford to cover their own current medical expenses out of pocket rather than drawing on the account immediately, to consider treating it as an additional powerful retirement savings vehicle, letting its balance grow untouched for decades, rather than simply spending it down each year as a routine medical expense reimbursement account. The authors share a specific account illustrating just how significant this particular strategy can become over a full investing lifetime, describing a forum member who had for many years simply used this account exactly as most people casually assume it's meant to be used, submitting routine medical expenses for reimbursement each year and keeping the balance perpetually low. After learning through the community about the considerably more powerful long-term strategy of paying smaller medical expenses out of pocket while letting the account itself grow untouched for decades, that same member described a genuine shift in how they thought about the account entirely. No longer viewing it as simply a convenient way to pay for this year's medical bills with pre-tax dollars, but as a genuinely significant additional retirement savings vehicle hiding in plain sight. 1. They'd simply never fully understood or utilized before encountering the community's detailed guidance on the subject. They share a specific illustrative example of a forum member who had, before discovering the community, held a considerable amount of a fairly tax-inefficient bond fund within an ordinary taxable brokerage account, generating an unnecessarily large annual tax bill each year purely by accident, having never actually considered the specific asset location question at all. After receiving detailed, patient guidance from several experienced community members, that same investor restructured their overall accounts, moving the tax-inefficient bond holdings into a tax-advantaged account and shifting more tax-efficient stock holdings into the taxable account instead, meaningfully reducing their overall annual tax bill without changing their underlying asset allocation or overall investment strategy in any substantive way at all. The authors describe this specific kind of restructuring, sometimes discussed within the community using the phrase tax-efficient fund placement, as one of the more genuinely valuable yet frequently overlooked opportunities available to investors holding money across multiple different account types simultaneously, since it requires no additional saving, no additional risk, and no change whatsoever to an investor's underlying overall asset allocation, simply a smarter, more deliberate arrangement of exactly where each specific holding actually sits, extracting real, measurable additional value purely through more thoughtful organization rather than through any change in the underlying investments themselves. The authors also address a specific, closely related decision many investors eventually face, whether to prioritize contributing to a traditional tax-deferred account, paying taxes later in retirement, or a tax-free account, paying taxes up front in exchange for tax-free withdrawals later. They walk through the underlying logic behind this decision in accessible terms, explaining that the right choice depends heavily on an individual's own expectation about whether their tax rate will likely be higher or lower during retirement compared to their current working years. A genuinely uncertain prediction that reasonable, well-informed people can disagree about, and one the authors encourage investors to think through carefully rather than simply defaulting to whichever option happens to be more commonly discussed or more prominently featured by a given employer's retirement plan. They offer a specific, practical piece of guidance for readers genuinely uncertain how to weigh this decision for their own circumstances, suggesting that younger investors early in their careers and likely still climbing toward their own eventual peak earning years often benefit from favoring the tax-free option, since their current tax rate is often lower than what they might reasonably expect during their higher-earning middle career years, let alone during a well-funded retirement. They note, too, that some investors reasonably choose to split their contributions between both account types, hedging against the genuine uncertainty of predicting future tax rates decades in advance, rather than committing entirely to one single approach based on a prediction that, however carefully reasoned, remains fundamentally uncertain. The ninth principle, invest with simplicity, captures something the entire community has come to value deeply through years of collective shared experience, that an overly complicated investment strategy, however sophisticated it might sound, tends to introduce more genuine risk, more genuine cost, and more genuine opportunity for costly mistakes than a considerably simpler, more disciplined approach ever would. The authors point specifically toward what has become perhaps the community's single most famous, most widely recommended practical strategy, something called the three-fund portfolio. They devote considerable attention to explaining exactly why simplicity carries such genuine practical weight within the community's own collective philosophy, walking through several specific mechanisms by which added complexity tends to quietly undermine an investor's genuine long-term results. A more complicated portfolio, holding dozens of different specialized funds, requires considerably more ongoing attention and expertise to properly maintain and rebalance, creating more opportunities for an investor to simply lose track of their own overall allocation over time. It also tends to carry higher aggregate costs, since specialized, narrowly focused funds frequently charge higher expense ratios than broad, simple index funds. And perhaps most importantly, the authors argue, a genuinely complicated portfolio is considerably harder for its own owner to fully understand, making it correspondingly harder for that same investor to maintain genuine, well-grounded conviction during an inevitable market downturn. Precisely the kind of conviction the entire stay. The course principle depends on holding firm. They offer a related, memorable phrase repeated often throughout the community's own discussions, describing simplicity, not as a compromise or a shortcut taken by investors who couldn't handle something more sophisticated, but as itself a genuinely sophisticated conclusion, one arrived at only after careful, thorough consideration of the alternative. The authors point out that many of the community's own most experienced, most financially knowledgeable members, people who could easily construct and maintain a far more elaborate portfolio if they genuinely believed doing so offered a meaningful advantage, ultimately choose the same simple three-fund structure themselves precisely because their own extensive knowledge had led them to conclude that the added complexity of more elaborate alternatives rarely justified its own additional cost and risk. They share a specific illustrative account from the community's own history, describing a forum member who arrived seeking help after having accumulated over many years a genuinely bewildering collection of over 20 different specialized mutual funds, each recommended at different points by different financial advisors, each pursuing a somewhat different narrow strategy with substantial confusing overlap between many of the individual holdings. After patient, detailed community guidance, that same investor eventually consolidated the entire unwieldy collection into the simple three-fund structure the community so consistently recommends, describing the resulting sense of clarity and relief as genuinely transformative, no longer needing to track 20 separate funds' individual performance, no longer paying the accumulated weight of 20 separate sets of fees, and finally able to fully confidently understand exactly what their own portfolio actually held and why. This specific strategy, endlessly discussed and refined across the community's own forums over the years, involves holding just 3 broad low-cost index funds. 1 covering the entire domestic stock market, 1 covering the broader international stock market, and 1 covering the broader domestic bond market, combined in proportions tailored to an individual investor's own specific age goals and personal tolerance for risk. The authors describe the genuine, almost startling simplicity of this approach as one of its single greatest strengths, since a portfolio this straightforward can be fully understood, fully managed, and fully maintained by an ordinary individual investor, with no need for expensive professional management, no need for constant monitoring, and no genuine risk of the kind of costly complexity that so often undermines less disciplined, more elaborate investment strategies. The authors walk through the specific reasoning behind including each of these 3 particular funds, rather than some larger, more elaborate collection of holdings. The domestic stock fund captures ownership in the entire home country's economy, spanning every industry and every company size, from the largest, most established corporations down to considerably smaller, faster-growing businesses. The International Stock Fund extends that same broad ownership beyond domestic borders, capturing economic growth happening across the rest of the world's developed and developing economies, providing genuine diversification against the specific risk of any single country's economy underperforming relative to the rest of the globe. The bond fund provides the portfolio's stabilizing counterweight, a source of steadier, more predictable returns that tend to hold up relatively well during periods when stocks are declining sharply, cushioning the overall portfolio's volatility precisely when that cushioning is most needed. They describe the specific origins of this particular three-fund approach within the community's own history, tracing its development back through years of extensive forum discussion and debate, as members compared notes on their own personal portfolios, gradually converging through countless individual conversations and shared spreadsheets on this same simple three-part structure, as offering nearly all of the genuine diversification benefit. A much more elaborate portfolio might promise, while requiring dramatically less ongoing effort, cost, and complexity to actually maintain over an entire investing lifetime. They walk through one specific recurring debate that has occupied countless individual forum threads over the years: the precise proportion of international stocks a well-constructed three-fund portfolio should actually hold relative to domestic stocks. The authors present this specific debate with genuine even-handedness, walking through the arguments on each side, some community members favoring a proportion roughly matching the international market's actual share of total global stock market value. Arguing this represents the most theoretically sound, unbiased approach, others favoring a somewhat smaller international allocation, citing certain practical considerations around currency risk and modestly higher costs historically associated with international index funds. Rather than declaring one specific position definitively correct, the authors present this ongoing debate as a genuinely healthy, constructive feature of the community's own culture, evidence of thoughtful, evidence-based disagreement conducted respectfully among people who fundamentally share the exact same broader underlying philosophy, even while disagreeing on this one specific, genuinely debatable detail. The authors are careful to note that this three-fund approach isn't presented as the single, only correct way to build a portfolio, acknowledging that some experienced community members have thoughtfully added a small handful of additional funds to their own personal variations, perhaps a dedicated real estate fund, or a separate allocation to smaller companies believed to carry a modest long-term return premium. But they consistently return to the same underlying message throughout these discussions: that added complexity should only ever be introduced deliberately, with a clear, well-understood rationale, rather than simply accumulated carelessly over time, since every additional fund introduces additional decisions to make, additional rebalancing to track, and additional opportunity for the kind of costly, complexity-driven mistakes. The entire simplicity principle was specifically designed to help investors avoid in the first place. The authors devote a dedicated section to the specific practice of rebalancing, an ongoing maintenance habit closely connected to the simplicity principle, but distinct enough to deserve its own detailed treatment. Over time, as different asset classes within a portfolio grow at different rates, the original intentional balance between them naturally drifts a strong multi-year stretch for stocks, for instance, gradually pushing a portfolio's stock allocation higher than originally intended, without the investor ever having made any conscious decision to take on that additional risk. Rebalancing simply means periodically restoring that original intended balance, selling a portion of whatever has grown disproportionately large, and redirecting that money toward whatever has fallen behind. They walk through several specific, practical approaches the community has debated and refined over the years for actually implementing this rebalancing habit, some members preferring a simple calendar-based approach, checking and rebalancing their portfolio once a year, on a fixed date, regardless of market conditions. Others preferring a threshold-based approach, only rebalancing once a specific asset class has drifted beyond some predetermined percentage away from its original target. The authors present both approaches as reasonable, evidence-supported options, emphasizing that the specific method matters considerably less than simply having some consistent, disciplined system in place at all. rather than either constantly obsessively adjusting a portfolio in response to every market fluctuation or never rebalancing at all and allowing an original, carefully considered allocation to drift indefinitely. They offer a further practical piece of guidance for readers whose accumulated savings span multiple different account types: an employer retirement account, an individual retirement account, and an ordinary taxable brokerage account, all held simultaneously, encouraging these readers to think about their own overall asset allocation as a single unified whole spanning all of these accounts together, rather than trying to maintain the exact same specific mix independently within each individual account. This unified approach, the authors explain, allows an investor to take fuller advantage of the specific tax efficiency considerations discussed earlier, placing tax-inefficient holdings preferentially within tax-advantaged accounts and tax-efficient holdings within taxable accounts, while still maintaining their genuinely intended overall balance between stocks and bonds when all accounts are considered together as a single coordinated portfolio. They share a specific account from the community's own archives describing the psychological benefit rebalancing can provide during a genuinely difficult market period. Since the mechanical act of rebalancing during a downturn actually requires selling whatever asset class has held up relatively well, typically bonds, and using those proceeds to buy more of whatever has fallen the most, typically stocks, precisely the kind of disciplined, buy-low behavior that raw human instinct actively resists during a period of genuine market fear. Several forum members describe this specific mechanical discipline as having genuinely helped them stay the course during periods when their own emotional instincts were screaming at them to sell everything and retreat entirely to cash. One specific member's account, referenced repeatedly throughout the book, describes forcing themselves to follow their own predetermined rebalancing rule during a particularly severe downturn, despite every emotional instinct urging them to simply sell everything and wait for calmer conditions instead. That same member later described the experience of mechanically executing a rebalancing trade, buying more stocks precisely while the market felt most frightening, as one of the single hardest financial actions they'd ever taken, and simultaneously one of the most rewarding once the eventual recovery arrived, reinforcing their own confidence in the entire predetermined system precisely because it had forced a genuinely difficult, counterintuitive action their own unaided emotional judgment would never have chosen to take on its own. The 10th and final principle, stay the course, brings the entire framework full circle, back to the same underlying discipline and patience that runs throughout the entire book. The authors describe this final principle as in many ways the most genuinely difficult of the entire list to actually maintain consistently, since it requires resisting a great many powerful, entirely human impulses, the temptation to chase whatever investment happens to be exciting at the moment, the temptation to panic during an inevitable market downturn, the temptation to constantly tinker with an otherwise sound, carefully constructed portfolio simply out of restless impatience. They devote considerable attention to the community's own collective experience, navigating several genuinely severe market downturns over the decades since the forum's founding, describing how the community itself functioned during each of these difficult stretches. As a kind of collective support system, members posting in real time about their own genuine anxiety, other members responding with calm reminders of the community's shared long-term principles, historical data showing previous downturns eventually recovering, and simple, patient encouragement to stick with an already well-considered plan, rather than making a panicked, emotionally driven decision in the heat of the moment. One specific thread from the community's own history, referenced repeatedly throughout the book, describes a particularly severe downturn during which forum activity spiked dramatically, as anxious members sought reassurance from the broader community precisely when that reassurance mattered most. The authors describe the specific tone of those archived conversations as remarkably calm and consistent, experienced longtime members patiently walking newer, more panicked members through the same core principles again and again, individual reply by individual reply, until the collective, accumulated weight of that patient, repeated reassurance helped a great many members actually stick with their original plan through the entire downturn rather than selling in a panic near the exact bottom. Precisely the costly mistake the community's collective wisdom had specifically formed to help protect its own members against. The authors describe this specific function of the community providing genuine, real-time emotional support during precisely the moments an investor's own discipline is most severely tested, as one of the book's own most valuable, if least tangible contributions, something considerably harder to fully capture in a simple list of investment principles alone, yet arguably every bit as important to genuine long-term investing success as any of the more technical numbers-based guidance covered throughout the rest of the book. They extend this discussion to address a related, practical piece of guidance for readers who might not have easy access to this kind of supportive community themselves, encouraging them to consider writing out their own personal investment plan in advance, in plain, simple language, specifically describing their own reasoning for their chosen asset allocation and their own explicit commitment to staying the course through an eventual inevitable downturn well before that downturn actually arrives. The authors describe this specific written document, sometimes referred to within the community as an investment policy statement, as a genuinely useful substitute for the kind of real-time community reassurance forum members receive from each other, since a calm, well-reasoned plan, written during a period of genuine calm and clarity, can serve as an anchor to return to during a later period of genuine fear and uncertainty, when an investor's own in-the-moment judgment is least reliable and most vulnerable to exactly the kind of costly, panic-driven decision the entire stay, the course principle exists to help prevent. Before any of these later principles about actually investing money can genuinely apply at all, the authors insist on addressing a foundational step many personal finance books skip past too quickly: building a genuine emergency fund. They recommend setting aside enough easily accessible cash to cover several months of essential living expenses held in a simple, safe savings account rather than invested in the stock market at all, specifically so that an unexpected job loss, medical expense, or other genuine emergency never forces an investor to sell their long-term investments at exactly the worst possible moment, purely out of desperate, immediate necessity. The authors walk through the specific reasoning behind recommending several months of expenses rather than some smaller or larger figure, acknowledging that the exact right amount genuinely varies depending on an individual's own specific circumstances, job security, and family situation. Someone working in a genuinely stable, predictable profession with a reliable dual-income household might reasonably maintain a somewhat smaller emergency fund than someone working in a considerably less predictable field or supporting an entire household on a single income. They encourage readers to think through this specific calculation honestly for their own particular circumstances, rather than simply adopting a generic one-size-fits-all number without genuine consideration. They walk through a further related consideration many readers overlook when first calculating their own appropriate emergency fund size: the specific question of how quickly an individual could realistically expect to find comparable new employment in the event of an unexpected job loss, a factor that varies considerably depending on an individual's own specific industry, geographic location, and current broader economic conditions. Someone working in a highly specialized field with relatively few comparable employers in their immediate area, the author's note might reasonably maintain a larger emergency cushion than someone working in a field with abundant, readily available alternative employment opportunities, since the genuine, realistic timeline for replacing lost income differs meaningfully between these two situations, even if their monthly living expenses happen to be identical. They share a specific, cautionary story from the community's own archives describing a forum member who had, prior to discovering the community's guidance, invested essentially all of their available savings directly into the stock market, with no meaningful emergency reserve set aside at all. When an unexpected job loss arrived during a period when the broader market also happened to be experiencing a genuine downturn, that same member found themselves forced to sell a meaningful portion of their long-term investments at precisely the worst possible moment, locking in real, permanent losses that a properly maintained emergency fund would have entirely prevented. The authors present this specific story as a powerful real-world illustration of why this foundational step deserves genuine priority before an investor ever turns their attention toward the more exciting, more commonly discussed question of which specific investments to actually choose. The authors devote real, practical attention to a related, closely connected topic many personal finance books address only briefly: the specific question of paying down existing debt before beginning to invest more aggressively. They walk through a fairly straightforward common-sense framework for thinking about this decision, comparing the guaranteed, certain return of paying off a high-interest debt against the merely probable, uncertain return of investing that same money in the market instead. A credit card balance carrying an extremely high interest rate, they argue, represents in effect a guaranteed negative investment return of that exact same magnitude, one that virtually no realistic long-term market investment could reliably be expected to outpace. Making the decision to prioritize paying off that specific debt first, an unusually clear, unambiguous one, considerably more straightforward than most of the genuinely nuanced investing decisions covered elsewhere throughout the rest of the book. They walk through a specific, more nuanced discussion of how to think about debt carrying more moderate interest rates. A typical mortgage or a moderately priced auto loan, for instance, where the comparison against expected market returns becomes considerably less clear-cut. In these more ambiguous cases, the authors present both sides of the decision, fairly noting that some community members strongly prefer the guaranteed certain psychological relief of becoming completely debt-free as quickly as possible, while others prefer to continue making only the minimum required payments on lower interest debt, directing any additional available money toward investing instead, on the reasoning that long-term market returns have historically, though not with absolute certainty, tended to exceed the interest rate on this kind of more moderately priced debt. They offer a specific practical decision-making framework for readers genuinely uncertain which approach best suits their own circumstances, encouraging an honest self-assessment of their own personal comfort with carrying debt at all, since the community's own collective experience suggests that the psychological weight of outstanding debt affects different individuals quite differently. Some people feeling perfectly comfortable maintaining a low-interest mortgage for its full term while investing aggressively elsewhere, others finding that same outstanding debt a persistent source of genuine anxiety that no amount of favorable mathematical comparison ever fully resolves. The authors encourage readers to weigh this genuine psychological dimension seriously alongside the purely mathematical comparison. Since a technically optimal financial strategy that leaves an investor genuinely anxious and unable to sleep well at night isn't actually serving that investor's genuine overall well-being particularly effectively regardless of what the raw numbers alone might suggest. They share a specific account from the community's own archives illustrating this exact tension in vivid concrete terms, describing a forum member who, despite understanding the mathematical argument for maintaining a low-interest mortgage while investing extra money elsewhere, found themselves unable to genuinely relax and enjoy their own accumulating investment gains, constantly aware of the outstanding mortgage balance sitting in the background of every financial decision. After discussing the situation openly with the community, that same member ultimately chose to prioritize paying off the mortgage more aggressively than the pure mathematics alone would have recommended and described a genuine, meaningful improvement in their own overall sense of financial peace once the mortgage was finally fully paid off, even having, by their own calculation, likely sacrificed some amount of theoretical additional investment return along the way. The authors present this account approvingly, using it to reinforce their broader point that the community's own principles were never meant to be applied as rigid, purely mathematical formulas divorced from an individual's own genuine emotional well-being, but rather as thoughtful guidance to be weighed honestly against each reader's own specific circumstances and temperament. The authors devote a dedicated section to a topic many personal finance books address only in passing: the basics of insurance and estate planning, treating both as essential foundational pieces of a genuinely complete financial plan, rather than optional extras to consider only once an investor's portfolio has already grown substantially. They walk through the specific role adequate insurance coverage plays in protecting an otherwise carefully constructed investment plan, pointing out that a single serious uninsured event, a major illness, a lawsuit, an unexpected disability, can potentially undo years or even decades of disciplined saving and investing, making adequate insurance coverage in their assessment every bit as important a piece of genuine financial security as the investment principles covered throughout the rest of the book. They frame this specific section using a phrase that recurs throughout the book in various forms, describing insurance and estate planning together as the protective foundation underneath an investment portfolio rather than a separate, unrelated topic. A beautifully constructed three-fund portfolio diligently maintained and rebalanced for decades, the authors point out, offers relatively little genuine protection against a single catastrophic uninsured event capable of wiping out a family's entire financial foundation in one stroke, which is precisely why they insist on addressing this specific foundation before readers turn their fuller attention toward the more commonly discussed, more exciting question of which specific investments to actually hold. They walk through the basics of several common insurance categories in accessible terms, encouraging readers to think honestly about their own specific circumstances, their dependents, their income sources, and their existing assets. When determining what level and type of coverage genuinely makes sense for their own particular situation, rather than either over-insuring, unnecessarily paying for coverage that doesn't genuinely address any realistic risk they actually face, or under-insuring, dangerously leaving a genuine catastrophic gap in protection that could unravel their entire financial plan in a single unfortunate event. They pay particular attention to life insurance, walking through the distinction between simple, relatively inexpensive term coverage, providing a straightforward death benefit for a fixed period at a genuinely affordable cost, and considerably more complicated, more expensive permanent policies that bundle life insurance together with an investment component. The authors present a fairly consistent, well-supported community position on this specific comparison, generally favoring simple term coverage For the overwhelming majority of ordinary families' genuine insurance needs, while investing any additional available money separately. Through the same low-cost index fund approach discussed throughout the rest of the book, rather than paying the considerably higher combined costs typically embedded within a bundled permanent policy. They walk through the specific reasoning behind this general preference in some detail, explaining that the investment component bundled within a typical permanent policy tends to carry considerably higher embedded costs than a comparable standalone low-cost index fund would charge, meaning an investor generally comes out ahead in most ordinary circumstances, purchasing the simpler, cheaper term coverage separately and investing the resulting savings independently, rather than paying for both protections bundled together within a single, more expensive combined product. They're careful to note genuine exceptions exist for certain specific circumstances, particular estate planning situations or specific tax considerations that occasionally make a permanent policy genuinely advantageous for a narrow subset of readers, but treat this general guidance as a reasonable, evidence-supported starting point for the large majority of readers evaluating their own life insurance needs for the first time. They also address disability insurance specifically, an often overlooked coverage category the community has come to consider genuinely underappreciated relative to its actual importance, protecting an individual's ongoing income, arguably their single largest financial asset during their working years, against the very real possibility of a serious illness or injury preventing them from continuing to work. The authors share several accounts from the community's own history of members who had never seriously considered this specific coverage until a genuine health scare. Either their own or a close family member's brought the real practical risk into sharp, sudden focus, several describing genuine relief at having secured adequate coverage before that risk actually materialized, and considerable regret among those who hadn't. They walk through the specific reasoning behind why this particular coverage category tends to receive considerably less attention than life insurance, despite arguably representing an equally significant financial risk for most working individuals, pointing out that the prospect of a serious, career-altering disability simply feels less immediately vivid and less commonly discussed than the prospect of death, even though actuarial data the community has examined suggests the actual probability of experiencing a significant income-disrupting disability during an ordinary working career is considerably higher than most people intuitively assume. The authors encourage readers to check whether their own current employer already provides some baseline level of disability coverage, and to seriously evaluate whether that existing coverage, if any, genuinely provides adequate protection relative to their own actual living expenses and financial obligations, rather than simply assuming without verification that adequate protection is already quietly in place. The authors extend this same practical foundational thinking into a discussion of basic estate planning, encouraging every reader, regardless of their current level of accumulated wealth, to have at minimum a simple, valid will in place, along with properly designated beneficiaries on every retirement and investment account they hold. They share a specific sobering account from the community's own archives describing a forum member who had passed away without a valid will in place, leaving behind a genuinely difficult, drawn-out legal process for surviving family members to navigate, one that could have been avoided entirely through a relatively simple, inexpensive piece of estate planning completed years in advance. The authors present this account not to alarm readers unnecessarily, but to underscore a point they consider genuinely underappreciated, that even the most carefully constructed investment portfolio ultimately depends on this kind of basic estate planning to actually ensure it reaches the people an investor genuinely intended to benefit from it. They extend this discussion with a related, practical piece of guidance. The community frequently emphasizes encouraging readers to revisit their designated beneficiaries periodically, particularly following major life events like a marriage, divorce, birth of a child, or death of a previously designated beneficiary. Since these specific account designations typically take legal precedence over even a properly drafted will, meaning an outdated beneficiary designation, however small an oversight it might seem, can genuinely override an investor's own more recently updated intentions. They share a specific cautionary account from the community's archives describing a forum member who discovered only after a close family member's death that a decades-old, long-forgotten beneficiary designation from an early stage of their career had inadvertently directed a meaningful retirement account balance toward someone the deceased had clearly, by every other indication, intended to no longer be the primary beneficiary, a painful, entirely avoidable outcome the authors use to reinforce just how much genuine care this often overlooked administrative detail actually deserves. The authors devote a dedicated section to a specific recurring danger the community has watched claim countless otherwise sensible people over the years. The seductive pull of get-rich-quick schemes and speculative fads promising returns far beyond what any legitimate sustainable investment could reasonably be expected to deliver. They walk through a fairly consistent, recurring pattern the community has observed across decades of encountering these schemes in various different forms. An exciting new opportunity emerges, promising extraordinary, seemingly guaranteed returns, drawing in eager participants through enthusiastic word of mouth and persuasive marketing, before eventually collapsing, often taking a great deal of participants' hard-earned savings down with it. They share several specific cautionary accounts from the community's own history, describing forum members who arrived seeking guidance after having already lost substantial sums pursuing one or another of these speculative schemes, each story sharing a remarkably similar underlying shape, despite involving entirely different specific investments. Genuine excitement about extraordinary promised returns, genuine social pressure from friends or family members already involved, and a genuine retrospective recognition, once the scheme inevitably collapsed, that the promised returns had simply never been mathematically plausible in the first place. Had anyone paused to examine the claims skeptically before committing real money? The authors offer a specific practical heuristic the community has come to rely on repeatedly when evaluating any new exciting investment opportunity. A simple, blunt reminder that any investment promising returns significantly exceeding what a broad diversified stock market index has historically delivered, especially when described as low risk or guaranteed, deserves immediate thorough skepticism rather than excited enthusiasm. They connect this specific heuristic directly back to the entire community's founding philosophy that genuine sustainable wealth has always been built patiently through disciplined saving and broad diversification rather than through any single exciting shortcut, and that any opportunity promising to bypass that patient discipline entirely deserves, at minimum, the same careful evidence-based scrutiny the community applies to every other financial claim. They devote particular attention to a specific psychological mechanism the community has come to recognize repeatedly. Across these recurring speculative episodes, the powerful pull of watching friends, family members, or online acquaintances apparently profiting handsomely from a particular scheme, generating genuine visible social pressure to participate rather than be left out of what appears, at least temporarily, to be a genuinely successful opportunity. The authors encourage readers to recognize this specific social pressure explicitly whenever they notice it arising in their own thinking, treating the mere fact of feeling that pressure as itself a meaningful warning sign worth pausing over rather than a genuine signal that the underlying opportunity itself has actually become more soundly grounded simply because more people happen to currently be excited about it. They extend this same skepticism into a related discussion of ordinary financial media noise. The constant stream of confident predictions, exciting headlines, and urgent-sounding recommendations that fills financial news coverage on a daily basis. The authors encourage readers to treat this constant stream of noise with the same measured skepticism applied to more obvious get-rich-quick schemes, pointing out that financial media funded largely through advertising and viewership has a structural incentive to generate exciting, attention-grabbing content regardless of whether that content genuinely serves an ordinary long-term investor's actual best interests. They share a specific recurring piece of community wisdom on this exact point, encouraging members to limit their own consumption of daily financial news considerably, since a disciplined long-term investor following the community's own core principles genuinely has very little need to react to any single day's headlines at all, and reducing that constant exposure to exciting, anxiety-inducing noise tends to make the broader discipline of staying the course considerably easier to actually maintain. If any of this resonated with you, the full narration series continues on the Money Files audiobooks channel, where books exactly like this one get broken down in this same long-form, deep-dive style perfect company for a long commute, a quiet workout, or simply falling asleep to something that might genuinely leave you thinking differently about what real, sustainable financial discipline actually looks like when it's built collectively by an entire community of ordinary people, rather than handed down from a single celebrity expert. If you're wondering what any of this actually looks like, translated into something you could genuinely start this week, the community's own decades of collective experience point toward a fairly simple, concrete starting sequence. First, calculate your own current essential monthly expenses and check whether you currently have several months' worth genuinely set aside in an accessible emergency fund, building toward that target first if you don't. Next, list out every debt you currently carry, along with its specific interest rate, and honestly assess whether any of it carries a high enough rate to justify prioritizing payoff before directing additional money toward investing. Then, look at whatever retirement accounts you currently have access to, checking specifically whether you're capturing any available employer matching contribution in full, since that specific match represents an immediate, guaranteed return before a single dollar has even been invested. And finally, if you're currently invested in a collection of individual stocks or expensive actively managed funds, spend an evening genuinely comparing that portfolio's costs and diversification against a simple, low-cost, three-fund alternative, and consider whether a gradual transition toward that considerably simpler approach might serve your own long-term interests better. You likely won't need to make every single one of these changes overnight, and the community's own collective wisdom would actively discourage rushing into any major financial change without first taking the time to genuinely understand the reasoning behind it. What matters is beginning the process, one deliberate step at a time, in exactly the same patient, methodical spirit that built this entire community over decades. One honest conversation, one shared mistake, one small correction at a time. There's a specific, quiet accessibility to the entire community's philosophy worth carrying forward, one distinct from a great deal of the rest of the personal finance world. Nobody within this community needed a finance degree, a six-figure income, or any special professional credential to genuinely participate and genuinely benefit. The entire movement grew and continues growing from ordinary people, teachers, engineers, retail workers, retirees, simply willing to read carefully ask honest questions, and patiently help each other apply a genuinely simple set of principles consistently over years. That accessibility, considerably more than any single specific investment recommendation, might be the book's own most enduring, most genuinely valuable contribution. There's a particular kind of quiet confidence that comes through in the way this book was actually written, worth naming directly before we close. It doesn't read like a single celebrity expert handing down wisdom from some distant, unreachable height. It reads like a patient friend, or more precisely like thousands of patient friends, each one having personally tested the same principles against their own real money, their own real fears, and their own real mistakes before ever passing that hard-won knowledge along to the next person who needed it. That's a genuinely rare thing to find in the personal finance world, and it might be worth remembering the next time you're tempted to trust a confident voice simply because it sounds authoritative rather than because it's actually been tested patiently by people with nothing to sell you. The next time you find yourself tempted by an exciting new investment strategy or genuinely uncertain about which specific direction to take with your own money, you might find yourself thinking back to that small, stubborn online community gathering quietly for decades, comparing notes, correcting each other's mistakes, and slowly, collectively proving something worth remembering, that the surest path toward genuine financial security was never found in any single brilliant insight or any single celebrity's confident prediction. It was found in a set of simple, unglamorous, thoroughly tested principles, repeated patiently together by ordinary people for decades, until those principles simply proved themselves true. And if you want to keep building your financial knowledge, don't stop here. Click the next Money Files audiobook on your screen. Every book we explore adds another piece to the bigger picture of investing, wealth, and financial independence. Subscribe to Money Files audiobooks so you don't miss the next one. And remember, you don't need to predict the market to build wealth. You need a good plan and the discipline to stay with it. I'll see you in the next audiobook.